It's 1 year on since Lehman's collapse, the fourth biggest investment bank in the US, which collapsed now almost exactly 1 year ago today. Well, to find out more, let's talk to correspondent Nathan King, who joins us live from New York. Nathan, then remind us, take us back 12 months. Why was Lehman's allowed to collapse when others had been bailed out?
Yeah, interesting, because remember, Bear Stearns, just a few months before, was rescued at the last minute and pushed into the arms of JP Morgan. A lot of people thought that Lehman was too big to fail. It was the fourth largest investment bank at the time. But the story from Hank Paulson, who was the Treasury Secretary at the time, and others, was that they couldn't find a buyer at the last minute. But there was also this feeling that perhaps Wall Street was getting away with too much, and there was too much moral hazard that basically all the banks would take risks. So Lehman was allowed to fail because they couldn't find a buyer, but also because there was this feeling out there that the government couldn't, or there wasn't the appetite for a rescue. But what followed that was cataclysmic. We saw 500 points drop off the Dow Jones Industrial Average, and within days, the US government had to move to shore up AIG. It changed the rules so banks, investment banks, could become bank holding companies and tap the Federal Reserve's discount window for rates. So the whole game changed overnight, and it also allowed Congress to pass a $700 billion stimulus package and central banks around the world to inject liquidity. So there's a feeling after a year, a consensus, if you like, emerging, that Lehman failed in order for the rest of the financial system to survive. It had to die, if you like, to prove that some of these banks had systemic risk.
So to sacrifice itself as such. But in terms of Wall Street itself, and their behaviour now 1 year on, would you say, or is the general consensus where you are, Nathan, that Wall Street's learnt their lessons after Lehman's collapse?
Well, remember, Lehman collapsed because it had huge exposure to the subprime mortgage market. And remember, a lot of those assets are now guaranteed by the government. So you're not seeing a rush back into mortgages, but what you are seeing is a return for risk appetite. Now, that's not necessarily bad, but a lot of this risk is based on free money from the Federal Reserve, i.e. the American taxpayer. And it's also, a lot of these banks are making money because there's less competitors in the marketplace. There's been mergers, of course, and some failures. So they're also paying very large bonuses indeed. Goldman Sachs this year has set aside so far about $3 billion. It could go much higher for bonuses. These are record profits for Goldman, and they're paying out record bonuses. And there is this feeling that perhaps if government doesn't act quickly, this crisis, which has been going on for a year, may be forgotten and lessons won't be learned. We'll wait and see in the next few weeks, because we've got the G20 summit coming up, of course, as well, and lots of action expected there.
Now, Nathan, just briefly, just before I let you go, obviously G20 summit coming up, but before that, we've got Barack Obama's speech later today. Do we have any idea what he's going to be talking about? What can we expect from that?
Yeah, we're hearing not to expect anything specifically new, but he's really going to try and sort of set the stage, if you like, for the G20 summit. He'll be looking for more authority from the government to wind down companies. He'll have a new oversight proposal for financial products for consumers, and generally also have more capital requirements for the big banks. But this whole idea at the beginning of this crisis, when Lehman collapsed, of breaking up big banks has gone away. Too big to fail is still the motto on Wall Street.